Hi, my name is Grant Reeves. I am the co-founder and managing director of Stoic Equity Partners. We are a commercial real estate investment firm in Daphne, Alabama. We focus primarily on flex industrial throughout the Southeast, and that's what I'm here to talk to you about today. Thank you to the LFI community for letting me present today, and look forward to jumping in. My screen shared here. We can get going. So, as discussed, we're here to talk about flex industrial today. We are going to start off just with a brief introduction. We will then get into what is flex industrial, different styles, different characteristics of the different ones, and then also the opportunity currently presenting itself in the flex industrial space. We will then transition and go over a couple of case studies of some properties that are currently in our portfolio, one in Little Rock, Arkansas, the other one in Ridgeland, Mississippi. But yeah, starting off on an introduction, as I said, my name is Grant Reeves. I co-founded Stoic Equity Partners with my business partner, Jeremy Friedman. In 2020, 2021 is really when we got going and started doing our first deals. Jeremy and I were longtime commercial real estate brokers and knew each other from that space for probably about a decade, and decided we always wanted to get on the principal side. And so through COVID, actually, we had a little bit of time to put our heads together, come up with the structure of what we wanted to do as far as what our own firm would look like. And that was kind of the brainchild of Stoic. We started off with our first deal in 2021. We bought $50 million worth of assets or developed a few of those. We had about 500,000 square feet of real estate and have raised just under 14 million from outside equity, currently placed money. We do currently have about 400,000 square feet under contract. So we are excited to see us we'll almost double in an asset square footage under management here in the next, 45 days, which is exciting. This is a little bit of our team. We actually have a little bit larger of a team here now, but we don't have headshots for them because they just started a couple weeks ago. But you have Jeremy and I that run the firm, and then we have Brent, who's in business development, Matt, who does our asset and project management, Sam's an analyst, and Haley runs our accounting department. We have a portfolio. We started off in self-storage. We have 4 self-storage properties, and then transitioned more into the flex industrial space in 2022. And the last 6 deals that we've done have been in the flex space. And also the next 4 deals, I guess we have in our contract right now, will all be flex as well. We really like that space as well. So that's enough about Stoic. We'll jump into the meat of everything today. So first thing I want to talk about is what is flex industrial. So there's a lot of different names for it. So people call it shallow bay, class B industrial. Even contractor garages kind of fall into the flex world. But pretty much it's a versatile commercial real estate asset that has a combination of both office and warehouse space. A lot of them are multi-tenant. Some of them can be multi or single tenant buildings, but they're usually located in industrial parks, business parks, and are constructed of either metal buildings, tilt wall construction. Sometimes you'll see block, or you'll see like a metal building with brick facade or something like that. So there is a mixture of construction types, but for the most part, we see metal buildings or tilt wall construction. The tenants and users of this space are so broad. You have everything from service companies to life science space, logistics firms like a FedEx or something like that. And so it's amazing how many different tenants can use this space, but that's also why they call it flex. It's very flexible, obviously. Kind of going more over the overview, as I said, it's going to be a mixture of office and warehouse spaces in each suite. Depending on the property, depending on the individual suite, you can have varying degrees of office throughout. So some units might have 10% office, others might have 60% office. And so it really just depends on the building itself. Obviously, right now, the units that have more warehouse are much more desirable, have a lot higher occupancy. Just through COVID, obviously, office is not as in demand. So there's actually a pretty good strategy that we've been implementing where we're ripping out office space and increasing the warehouse, and finding that to be a really good way to drive up occupancy and rate in these facilities. Many flex deals, and I'd say most really that I would consider flex, are multi-tenant. So you might have a 50,000 square foot building that's made up of 10 5,000 square foot suites. Again, broad range of tenants. Typical lease terms are 3 to 5 years. They'll usually have an annual increase as well. We also like to see those as be triple net leases. You do a lot of times see triple net leases and then in the industrial and then the flex space. That's really nice because you don't have as much risk on insurance increases, on property tax increases, and all that we've really seen come up in the past 2 or 3 years. Triple net lease, you're passing that along to your tenants, and your net income stays the higher, or really remains to increase year over year because of your percentage rent increases every single year. They're usually looking at industrial business parks, and then also you can have rear load and front load buildings. We'll talk a little bit more about that here shortly, and kind of what those differences are and what that looks like. This is a building we actually own in Little Rock, just as an example of flex. It has an office front, roll-ups and dock highs on the back. So the roll-ups and dock highs are along this side. The office front is here. It's 48,000 square feet, made up of 3,000 square foot units. There are a couple of tenants that have multiple units, but this unit right here is about 50-50 office warehouse. So they have a roll up here, office front there. So that's kind of what we do. Tenant profiles. So I mentioned before, they are very broad in what you could have. We see a lot of logistics firms, so FedEx, UPS, general trucking, even online stores. We have a few tenants that they use the space to take pictures, put it on their online stores, and then ship out of this facility. And so it's really amazing because it's all just e-commerce. And so as that continues to drive more and more growth, I think that will continue to see more and more demand for flex properties, as the space really fits that type of company very well. A lot of service companies, HVAC companies, different cleaning firms, general contractors, termite pest control companies, foundation repair is a big one that you see a lot of times. And then even life science space, which I guess that's life sciences, that's what I'm going to call it, but it's specialized pharmacies, laboratories, and a property we have under contract right now in Mississippi, Tyson Foods. That's why I have that logo on there. They have a large space and they have a full lab built out in there where they do product testing on kind of food safety. So on the chicken that they're distributing and doing different tests and that kind of thing on it. Then on pharmacies, like Omnicare is another tenant of ours. They do all the medication and IV bags for the entire state, and they distribute out of one of our facilities. And so it has a clean room in the space, some offices, and then the warehouse where they're actually doing the distribution. And then miscellaneous. Every flex deal we look at, I feel like you see a CrossFit gym, a cheer studio, or a dance studio. You also see car graphics, tinting, that kind of thing, auto repair. We don't have any auto repair in our current portfolio, just because they take up a lot of parking, but you will see that in flex space a decent amount. This is an example of just where flex kind of is in the market. Usually you see them, these yellow spots here are flex industrial, and they're mixed into this larger industrial park. So this is in the Hoover Homewood submarket of Birmingham, Alabama. I just picked a random market just to be able to show what we're talking about. But like, this is a large manufacturing facility. A lot of these are like single tenant industrial buildings throughout here, and just a large industrial park. But what we're looking at are these buildings in here that are office warehouse complexes. So they'll be just kind of littered throughout those parks. A lot of times you'll find flex kind of in the suburbs and the neighborhoods, which makes sense. A lot of the tenants are regional or local even firms. And so the local HVAC contractor would like to have his office be close to his house, right? And so that need to be in a heavy industrial area and a downtown market or something like that. It's usually going to be out in the suburbs is where we find a lot of these properties. And then currently in the market, we see a lot of different debt options. You have regional banks, life insurance companies, CMBS. On the regional bank side, just be a little bit higher leverage. You can loop in some of your construction costs, which has been really nice. A lot of these properties will require some new roofs, new parking lots, painting the exteriors, renovating the suites, doing some stuff like that. So it's nice to have a bank loan that you're able to draw some of that construction proceeds from. You also have life insurance companies that are very interested in the space. They're lower leverage, but much better rates. We actually have a deal under contract right now that we have a 5.95 rate on, but still that 6 to 7% rate is kind of the best we're seeing in the market right now. CMBS is active in the space. They're a little bit higher on interest rates, have really good amortization, 10-year terms, sometimes 5. but CMBS is a little bit hard to deal with sometimes. We prefer to kind of play life insurance regional banks more. But I mean, CMBS is a great option. The terms are great if you can stomach the process going through it. Anyone who's ever gone through a CMBS deal can attest to that. I mean, I will say these are also just kind of blanket terms of different term sheets that we've seen recently. There's a lot of different lenders out there. There's a lot of different structures out there, but this is kind of what we've been seeing in the market overall. One thing I did want to point out is what flex industrial is not. And this is what we would call bulk industrial. When you say industrial real estate, this is kind of what people are picturing. This is a big Class A facility, probably in a very large market, and the building's probably a few 100,000 square feet. This is not what we would call flex. These are going to be 1 to 3 tenants usually. Those tenants can be even 50, 200,000 square feet per suite. A lot of times they're in tier 1 markets, so Dallas, Atlanta, Miami, those type markets. They have heavy manufacturing, large scale distribution, very small amount of office. I mean, it's true industrial space. So maybe 10%, 5% of all the leasable area will be office. And these are going to be your big tenants, so like Amazon, Walmart, Milwaukee Tools. The reason we don't go after this kind of product is not because it's a great asset class and long term it'll do really well, but because you have tenants like Amazon, Walmart, Milwaukee, these big credit tenants, the cap rates are a lot lower, the value adds a lot less, and it's much more of a stable asset on the front end. So your yields are going to be lower. Obviously, real estate's risk return, right? So a little bit more risk, a little bit more return. These are going to be very low risk, more low return, but great assets overall. It's just not what we do and not what we would call flex. So next, what I wanted to do is kind of go over a couple of different buildings and kind of show the different design examples that you can see in the flex world. Again, most people have seen flex. They just didn't know if someone says flex industrial. A lot of times people don't know exactly what you're talking about. So the first one we're going to go over, this is a property in Mississippi. And so this is kind of more your traditional, I'd say 1980s, 1990s build flex product. So you have office looking fronts here with dock highs and roll ups on the back. So this is the back of this building right here. And so it's going to be usually tilt wall construction, sometimes metal buildings with a facade on them. They're a little bit nicer. They usually have a decent amount of office in them, even as high as 50% per suite or even a little bit more. This is usually the type of parks that you're going to see your national tenants in. You also see kind of varying square footage sizes. Example 2 we'll look at is kind of more your contractor garages, and a lot of those will be all 2,000 square foot suites. These type of products you might see a few 1,500s, even up to a couple of 10,000s, just kind of depending on how they were built out. But overall, a very nice product, an older product. We really like that because it's a good value add opportunity on that. But a lot of them lay out kind of like this. So this is a 3 building portfolio here. You have your offices on the front here, and then this is going to be your truck court. So that's your dock highs over here, your roll up doors on the back here, and then you have your office fronts here. This is what those 3 buildings look like, just kind of showing the different sizes you can have in here. Like these are 10,000 square foot units. These are 4s, 5s. This is now smaller, but at this time when this floor plan was put together, that was 25,000 square foot single tenant. Now it's a bunch of 5s. And then you have even some 1,500 square foot units. So you can have a vast difference of sizes to be able to offer tenants when they come into the space, which is very nice because you're not pigeonholed into, you have a tenant that needs 7,000 square feet, but all you have is 3,000 square foot units. Well, that's actually a bad example because they could just have 2 units, but you get my point. You're going to have 3,000 square foot units and you have someone who needs 4. Maybe it doesn't work for them. It's not enough for them to get 2 units. Yeah, this is kind of traditional rear load flex industrial. Have a typical floor plan in that building is walk into, this is the office side, this is the warehouse side, this is where your roll-ups, dock highs are, this is your frontage on the road. You have a lobby, a couple offices, bathrooms, break room, conference room, a larger office back here, and then you enter the warehouse. Then you have 2 doors. In this facility, one of those is a roll-up, like grade level door, other is a dock high. But this suite is about 40% warehouse, I would say. But the nice thing about it is flexible. That's why I call it flex. So you could come in here, put a wall here, rip out all this, and make it more, I'd say 60-40 warehouse to office. If someone needed more warehouse space. This is the other kind of type of flex industrial we see a lot. This is also called contractor garages sometimes, but these are going to be very minimal office space and mainly warehouse space. Another thing I'll point out real fast, this type product will sometimes have, or a lot of times will have, conditioned warehouses. So they'll have heated and cooled warehouses. That's their construction type allows for that a little bit easier. Example 2 here, the contractor garages, a lot of times you'll have a conditioned office and bathroom, but the warehouse will be unconditioned. Just something to point out. A lot of times these will be more your mom and pop type tenants you'll see in this space, just mainly just due to the fact that it's unconditioned space, and also they're a little bit smaller usually on unit size, but still a very valuable product. They are cheaper to build, so you will see newer product of this being built. A big thing though in flex industrial is you don't see a ton of new supply coming on, primarily because the numbers are pretty difficult to make work. We'll get into that in a second, but you will sometimes see this type product built. It's usually front load, so meaning that the door, all the entrances are on the same side. And this one, actually, you walk in, has a single office here, a bathroom here, and the rest of this is warehouse. This is not my facility. This is just one that I saw as a good example online that I wanted to use. This is how the total property lays out. So these are all front load, as you can see, all the way through. And so like these buildings will have a demising wall here. And so like these units don't run all the way through. So you'll have an entrance here, entrance here. Kind of what I was talking about on example 1 is that that tilt wall space will have different sizes in the same park. You might have, like we saw, a couple 1,500 square foot spaces, a couple 10,000s, a couple 5s, that kind of thing. A lot of times these kind of parks, these front load metal contractor garage stuff, you'll see all the same size. And so, for instance, this one I think is all 2,000 square foot units, if I'm not mistaken, where each unit is exactly the same layout, usually the same amount of office, same amount of warehouse throughout. This is a floor plan I just kind of threw together. This is not from that deal, but just kind of shows what those usually lay out like. So you have a roll-up door here, your office door here, a little office, just single office usually, the bathroom, and then the rest of it is warehouse. Between the two, I mean, this type product versus this type product, they're both very nice. They both have kind of different uses. These are going to be more of your established businesses. A lot of times the contractor garages will be a lot more like a newer landscape company or something like that that's coming along, while this is going to have like a Terminex in it or something like that. Both have a lot of good tailwinds. Both are doing really well occupancy wise, rent wise throughout the Southeast, or really the country, and should continue for a long time. But those are kind of the two different food groups I feel like you see in flex a lot of times. So be able to go through that. And then also just kind of wanted to get into the opportunity that we see in flex industrial. Obviously, every asset class has different degrees of opportunity depending on market timing and just different times in the cycle. Currently, we're seeing a huge opportunity in flex, primarily in the Southeast, just because that's where we are. But I mean, I think the flex nationwide is undersupplied. There's a lot of demand for it, and there's just a lot of tailwinds to get into that space. And kind of the 4 main reasons that we look at is the high demand, low supply asset class. Very little flex industrial has been built over the past 2 decades. A lot of buildings that you've seen, and everyone in every market can kind of attest to this, but you've seen traditional office be built prior to 2020, obviously. And then you've seen a lot of bulk industrial. So like those big Amazon, Walmart kind of fulfillment center stuff come up. But you very rarely see flex property come up. So as markets have grown, especially the suburbs have grown, smaller businesses have grown, there's more and more need for this space. The demand has continued to rise. But there's not really been any new supply, which puts the entire market in a really good place to if you can buy good assets, be able to drive rate and occupancy over time. You can, for the most part, buy below replacement cost right now. Replacement cost on a lot of these deals will be $130, $140, $150 a square foot. In our portfolio, we've seen an average purchase price of about $92 a foot, which is an amazing discount to what it would cost to build it new. Any asset class that you can buy that far below replacement cost that still has a lot of demand that's required, then it's a really good place to be. Just overall, I mean, obviously you don't want to get into a situation where you're buying something because it's below replacement cost, but if there's no demand for it, that kind of doesn't help you. You can buy a lot of traditional office really cheap per square foot right now, but that doesn't necessarily mean that it's a great bet in my eyes. You got to have the demand piece to be able to make it make sense. On these also, we like that the vacancy risk is mitigated because you have multiple occupancies. So a single occupied building of any kind, any asset class, that one tenant leaves, you're negatively cash flowing very dramatically overnight. When you have a lot of small tenants, it's kind of the same play as multifamily. You can have 3, 4, 5 tenants move out, still cash flowing well. Sometimes you're doing just fine, even with a couple of vacancies out there. But you can kind of run it almost like a commercial multifamily deal because you have a lot of small tenants. I mean, it's the same thing that self-storage does, same thing that multi does. Service-based retail, multi-tenant retail is kind of the same play. We like that multi-tenant, smaller users. I think that's where Flex fits in. The other thing that's really positive with Flex is that's where business gets done. You need a large warehouse space as part of your workspace. You can't go work over Zoom. If you need to manufacture, distribute, just whatever your business may be, that is not a Zoom business. So you are always going to need to have an office warehouse space somewhere. And so it's really protected from the COVID work from home trend that we've seen over the past couple of years. On the value add piece, there's two main places that we've seen Flex Industrial really be able to perform nicely through a value add strategy. The number one is reducing office space. In these type assets, let me go back real fast. So we're talking about these kind of tilt-wall deals right here. A lot of times you'll see where they've built the offices, they just continue to build more and more offices into this warehouse. So that warehouse might be, here down now. Here, I actually draw it, I believe. Let's say that is now, it's like this is warehouse, all of this is now office. So that is most likely going to be sitting vacant. So a great value add in Flex Industrial right now is to be able to go in there, buy this facility, tear out a lot of this warehouse, back up to say this area, and be able to drive occupancy really well by doing that. So that is a very prominent way of driving value and overall returns in Flex Industrial right now. The other big thing that we see right now is just exterior upgrades. A lot of times industrial kind of gets left to the wayside as far as keeping up appearances and making it nice. Obviously it's industrial property, so a lot of people don't think that that's important, but this is where a lot of people go to work every single day, and you spend more time at your office than you do pretty much anywhere else usually. And so being able to go in, renovate the exteriors, so paint the exteriors, seal and stripe the parking lots, put new roofs on if needed, paint the buildings, goes a really long way of being able to drive up rates. Because really the whole play here is the same as any value add strategy, any asset class, where you're buying something that is below market rents, needs a facelift to be able to achieve new market rents. Pretty simple strategy, works in all asset classes really. It's just if you can find enough product that's still below market to be able to have tailwinds in the space. This is just talking a little bit more about industrial as all overall. Class B industrial and Flex Industrial are kind of the same thing. People use those words synonymously. We had a decline about 1 to 2% a year in Class B industrial. A lot of these are infill locations, so you continue to see less and less supply as demand again has continued to rise. Sorry, and currently nationwide you have about 94% occupancy. One of the lowest special servicing and delinquency rates in the country. That and self-storage are doing the best. This is from June, I guess, of 23, but has continued to do well as some other asset classes have seen some problems on delinquencies. Industrial as a whole is doing really, really well. And going back to the limited supply real fast, one of the main things that really drives flex industrial existing product right now is the fact that you can't make the numbers work usually on new product. There are exceptions to every single rule. This is not a hard and fast rule, but for the most part, it costs anywhere from 130 to 150 a square foot to build nice flex product, kind of more top of the market stuff. To be able to do that, you're going to have to be 15, $16 a square foot in rents to be able to make those numbers make sense. That's to be able to get you on a high enough yield on cost versus your debt to be able to make it make sense. Now, most of the markets that we see, you'll see rents of $8 to $12 at the high end throughout the Southeast of flex space. And so if the market's at $11 a square foot triple net, new buildings 140, it doesn't work. You're going to be building to about an 8% yield on cost, and that just doesn't move the needle these days. And so it's a really interesting asset class, because if someone does come on top of you, then it actually is going to help the overall market, because there's so much demand there that it's not really going to take away too many of those tenants. I mean, you build a new product, even a big one, you might take away 20 to 30 tenants in the market, but what you are going to do is you're going to drive up the rate of the whole market. So most of the markets we play in, we don't see any new supply, but if anyone does start building on top of us, they'll actually allow us to take rates from maybe $10 a square foot. They come in next door, they're charging 15. We can go to $13, still undercut them a lot, and drive our value of our properties really, really high, while still being the cheapest option in town, which is really amazing. So we do think that eventually someone will start building that supply. Just with how much demand there is, it just makes sense that somebody one day will start to construct it. You're seeing it a little bit on the contractor garage space, as I was saying. Those spaces are small enough that you can make the numbers work on even that $15 a square foot rental rate. If they're 1,500 square foot suites, sometimes you can make that work. So you are seeing some of that supply come in, but it's still very limited for my opinion. Overall, we see the best place to invest for flex industrial in the Southeast. We are biased, we're in the Southeast, but also just the migration that's coming down here from, and this is just showing from the Northeast, but really all over the country. Anybody in the Southeast can say that every day you can meet somebody at the grocery store that just moved there from somewhere else in the country. And so good growing markets is always a key to successful real estate, and where we see the most tailwinds. This is just kind of talking more about the Southeast and why it's doing well, especially on the industrial side. There's a lot of good labor markets down here, business friendly governments, which is good for industrial properties to be able to move in. On that, I mean, if you do have a big bulk industrial building come in, a lot of times the flex deals will do well that are next door, because there will be the suppliers for the big new plants. If you're big, kind of thing, fulfillment center, Amazon fulfillment center, you might have some guys that are the delivery drivers, like the 1099 delivery driver guys, they're rent flex space next door. So just because one area has big bulk warehousing being built doesn't mean that the flex there isn't also benefiting from that. Next part of this presentation, I want to go over just some case studies. So we talked about what is flex industrial, what the opportunity is, but wanted to kind of share two real life stories from our portfolio that highlight those overall trends that we're seeing, and those strategies come to life. So this is a deal that we bought in Ridgeland, Mississippi in November of 22. So we've owned it, what is that, about 15 months now. At time of purchase, it was 74% occupied. It's these four buildings here. Laser out. These, so that building, this one, and this one. So this is your traditional tilt wall flex. So we were looking at kind of like example one. So you have your office fronts here, and then your warehouse accesses here along the back. This is a single tenant building to Cintas. The rest of these are usually 1,500 to 5,000 square foot units throughout the rest of it. Excuse me. When we bought it, it was pretty highly built out as office, probably about 70% office throughout the entire thing, in most of the vacant suites. Sorry, the vacant suites were about 70% office on average. So what we have done, it was about 74% occupied when we bought it because of that heavier office use. So we have gone in, spent a couple $100,000 redoing the exteriors. First off, we redid the parking lots. Pictures was done in the middle of that. As you can see, this parking lot's not done yet, but these are all done. We put new roofs on the buildings, freshened up the landscaping. But then on the interiors, we went in and ripped out a lot of office and turned them into 40-60 office to warehouse or 50-50 office warehouse, and have seen great success by doing that. We bought it again 74% occupied in November 22. Today we sit at 86% occupancy, and we have 2 leases out right now that will put us at 95% occupied. So we'll go from 74 to 95% occupied in 18 months just by ripping out some office. It's really amazing to see how well that is done. And just again, it's such a supply tight market that as soon as those spaces come online, they're ready to go. One thing on Flex, these are smaller users usually. So it's not a thing where you can really wait for the tenant to come, then build it out. Some landlords you will see in the market kind of sit on the sidelines. They'll offer TI money to turn it into Flex when the tenant comes along, but they're not going to do it speculatively. We kind of feel like that's a mistake in the Flex market. I think that if you're a 2,000 square foot user and need it for your HVAC company, you don't really have 6 months for someone to build out your space. You need to have pretty much turnkey space. So we've had really good success going in and just going ahead and building them out, making them turnkey for tenants, and just letting those things continue to boost our occupancy and rates. These are kind of before and after photos. So as you can see, the old ballast roof here. So our new, nice, pretty white roofs, and redid the exteriors and just overall freshened up the property. Unfortunately, this picture was taken when we were doing our parking lot, so it's still a little rough there, but overall, good looking property now. This is the overall performance. So NOI month over or year over year for that same month, we're up about 10%. We're signing leases more like $10 net versus $740 net when we bought the property. And then occupancy, obviously, we've grown that a decent amount over the past year. Other property we'll talk about is that first one that I pointed out. It is 48,000 square feet of Flex in Little Rock, Arkansas, out in the suburbs of Little Rock, kind of in West Little Rock, if people are familiar. And this building is 48,000 feet. So this entrance is to a 3,000 square foot suite. This is a 3,000 square foot suite and on down. Has roll-ups, dock highs along the back here. We bought this property from a individual out west whose spouse had bought it years and years ago, and unfortunately passed away. And they had never really done anything with the property. It was 100% occupied. Was paying decent return for them based on what their basis was in the deal, because they bought it, I guess, in the late 90s. So they bought it so cheap that even with low rents, they're still cash flowing really well. So they're just kind of sitting there clipping coupons. We saw it as a great opportunity to really be able to drive rate. So we purchased the deal. I think we paid about $70, 65, 75, 60, $70 a square foot, somewhere in that kind of range. And redid the stucco exterior. We redid the parking lot. The roof's next, but it's not done yet. And then did some interior renovations and redid the landscaping. By doing that, the average lease rate when we bought this property was $4.56 triple net. We have signed 3 leases now. I think it's on the next page. 3 leases at $850, $850, and $815 triple net. Those are all 3 to 5 year deals. We underwrote $775, so we're really excited to see those higher lease rates come in. But again, it's just simple stuff like redoing the exteriors, just making the property nicer, and we've doubled the rates by doing that. Tenants want to see nicer places. People always, again, just they see industrial and they're just like, oh, it doesn't matter. It's warehouse space. It doesn't need to be nice. People spend a lot of time where they work. It's really nice to make them look more presentable, and you'll be able to drive more rate by doing that. Kind of get into some before and after photos here. So again, this is what it looked like when we bought it, and this is what it looks like now. And the performance has shown that. So going up and to the right, it takes a little bit of time to get these things really up and going. But overall, we're really excited about that asset and really excited about the new ones that we're buying. Well, that is it, everyone. Thank you so much for listening to my presentation on Flex Industrial, the opportunities there, what Flex is. This is a link to our website if you would like to learn more about what we do. And then also we do have a fund that owns Flex Industrial. So please follow this link if you'd like to learn more about that. Always happy to talk real estate of any kind. So please reach out if you'd like. Here's my email address, our office phone number. And thank you, everybody. Great talking to you.